Every crypto trader must know about the December tax trap. You cannot afford to ignore this information. If you understand how taxes work, you can minimize your losses, maximize your profits, but most importantly, keep the IRS off your back. So please pay attention. This video was made for people that live in the United States. And I want to clarify, I am not a licensed CPA. I am not a licensed accountant. So for any final tax decisions, please refer to a licensed tax professional. Welcome aboard the Bitcoin Express. My name is Chase. Let's get to it. When it comes to investing, we all know a person needs to understand the product they're investing in. They need to understand how to read basic charts and understand some basic concepts. But for some reason, we fail to highlight the importance of understanding how taxes work when it comes to investing. Whether you are one of the greatest hedge funds out there or someone like Warren Buffett, these guys know the taxes in and out, and it helps them minimize their losses and maximize their profits. So when it comes to crypto traders, you need to understand the December tax trap. I'm going to summarize the December tax trap quickly, and then I will explain it with examples. So with the December tax trap, this is when someone creates a tax gain for the year, and then they carry that profit into the next year by holding a asset such as cryptocurrency, but then that price of that cryptocurrency in the next year decreases in price, and now the person has no money to pay the tax they owed for the previous year. For example, in 2017, when cryptocurrency reached skyrocket prices, it was a famous Reddit post from this user who asked, "Did I ruin my life trading crypto?" What they did was they were trading a lot of crypto in 2017, creating major profits on paper. And then, of course, 2018 came, and this person was holding all of their profits in cryptocurrency, and the crypto markets tanked. And now this person owed hundreds of thousands of dollars of crypto from the previous year. Now, maybe what I just said is confusing, so I'm going to break it down step by step. When it comes to trading crypto, I think we all know if you buy crypto and sell it for cash, taxable event. And then I hope we all know this one as well. Trading crypto for another crypto is also a taxable event. So if someone buys Bitcoin at 10,000, the price of Bitcoin goes to 20,000. Now they take all their Bitcoin, trade it for Ethereum, that person just created a $10,000 profit. So they owe taxes on a $10,000 gain. Let's take an example. Let's say you have someone trading cryptocurrency in 2020, and maybe in January they went up, and then in May they went down, and then in September they went up. Sorry, my thing is messing up over here. September they went up again. Bottom line, at the end of the year, they're trading all this cryptocurrency, and they're up $5,000. So this person owes tax on $5,000. But the trap that a lot of people get into is they take that gain. They were trading cryptocurrency, whether it was Ethereum, XRP, Bitcoin Cash, Litecoin, whatever it is. They take that cryptocurrency and they carry it into the next year. So in this case, into 2021. Now what happens, or what could happen in 21, just like it happened in 2017 and 2018, is this cryptocurrency now loses all its value. So let's say someone bought $10,000 worth of Bitcoin in 2020, sold it, traded it for Ethereum once the price of Bitcoin was at 20,000. So there's a $10,000 gain. Now they're holding Ethereum. Now they carry that Ethereum into the next year, 2021, and Ethereum has a huge crash, maybe 50% or 70%. Now this person no longer has money to pay tax that they owed on the previous year. The IRS does not care. At the end of the year, especially December time, this is when you watching, have to go and look at your crypto trades and understand, are you up or are you down? And you have to also understand that it's cumulative. So let's say you were up $5,000 in the beginning of 2020, but then towards the end of the year, you didn't do so well and you were down 5,000. In the end of the day, when you add it all up, you're up zero. There is no tax liability. Also, when it comes to stocks and crypto, they're both considered capital gains, so they can write off each other. So if a person made $1,000 in stocks and lost $1,000 in cryptocurrency, at the end of the year, zero gain. There's no gains. Also, if someone makes $1,000 in stocks and then makes $1,000 in crypto, add that up, $2,000 in profit for the year that they need to pay taxes on. Now, this can work to your advantage as well. Of course, if cryptocurrency loses its value, you can use it as a write-off. For example, right now, I'll use a personal example. I bought some Chainlink this year at about $15, and right now Chainlink is at $13.54. So right now we're in December, and I'm watching this day by day. Especially when it comes that last week of December, I'm going to look at Chainlink and see, is it still at $13? Is it at $12? Am I at a loss? And what I'm going to do is I'm going to sell my Chainlink and create a tax write-off. But this is what's really great about crypto. I really like Chainlink. I don't want to get rid of my Chainlink. So when it comes to crypto, you can actually perform something called a wash sale, which is not allowed with stocks, but it is allowed with crypto because the IRS specifically states that wash sale rules only apply to securities, and cryptocurrency is considered a property, not a security. So what I am going to do, and I actually did this in 2018, is if, let's say, Chainlink in the last week of December is at $12 or $13, I bought it at 15, so I'm at a loss. What I can do is I can sell my Chainlink and buy it back immediately. So essentially, I never got rid of my Chainlink because I like Chainlink. I'm in it for the long run. But I essentially got rid of it on paper. I created a write-off, but I still own the exact amount of Chainlink that I owned before. I did this in 2018. 2018 was a very bad year for a lot of people in crypto. In 2018, I never actually sold my crypto for any cash. I never sold it, transferred money to a bank account. I still have the same amount of crypto in today that I had in 2018, but I created a tax write-off on paper, and I was able to use that and carry it over into the next year. And of course, calculating this myself is nearly impossible. So I use cryptotrader.tax, and they make it super easy and simple for me. So this is what I've been using for the past 3 years. I'm going to use it again this year. I plan on using it for the foreseeable future, unless there's a better tax software that comes around. Also, what I started to do this year is trade, not a lot, but within a Roth IRA. I have a Roth IRA with I Trust Capital, and all the gains that I make in this account are tax-free as long as I hold that cryptocurrency or hold those profits until after the age 59 and a half. So to show you this, pretty simple. If you buy Bitcoin at $10,000 and it goes to $100,000 and you have a $90,000 profit, as long as you hold that account, do not withdraw anything until after the age 59 and a half, it's tax-free. But also within this account, I can trade tax-free. At the moment, they don't have many cryptocurrencies. They have Bitcoin, Ethereum, XRP, Chainlink coming soon, Bitcoin Cash, Litecoin, EOS, Stellar. You can also buy gold and silver. So within this account, I can trade, and I don't have to worry about this December tax trap. I can make a gain in Bitcoin, then take all my Bitcoin and buy Ethereum. Then I can make gains in Ethereum and take all that Ethereum and buy Chainlink. As long as I hold that money and do not withdraw it until after the age 59 and a half, that's the catch here, it is tax-free. So you must understand how crypto taxes work. If you don't, you will get wrecked. And if you do understand them, as you can see, you'll have an advantage. Minimize losses, maximize profits, and most importantly, keep the IRS off your back. Like the video, subscribe to the channel. Thank you for listening, and I'll see you next time.